Hi everyone. Well, another year is complete, and as you no doubt witnessed, 2025 was a year of dramatic change, much of it driven by a single long-term transformation, AI. So in this video, we will cover four topics. Number one, a State of the Union summary of 2025's important structural shifts in the global environment. Number two, 2025 performance review, including significant dispersion of returns in markets, as well as in Montaka's portfolio. Number three, portfolio augmentations and positioning during Q4 of 2025. And number four, a preview of our new white paper called The AI Bubble Debate, Why Investors Should Re-Examine the Evidence. In 2025, several developments led many to begin to question some of the most established underlying assumptions of the global political economy. 2025 confirmed that we have entered a new era of great power competition for scarce resources, the destruction of old technology models, rising uncertainty around employment, and political upheavals linked to inequality and an uncertain future, particularly for younger cohorts. At the heart of most of these developments is AI. So daily users of Gemini or ChatGPT or Claude will know just how useful these large language models, or LLMs as they're known, can be in daily life. This, in turn, is driving enormous capital investments in new data centers in the US as well as all around the world. So while investment in capital infrastructure is wonderful for current and future economic growth, just the sheer scale and growth of new demand is creating bottlenecks and competition for scarce resources, including between world powers who view AI dominance as a national security imperative. Now, two of the most critical inputs for data centers, as you know, are advanced semiconductor chips, as well as power for generation capacity. The rising compute intensity of AI software is driving enormous demand for specialized high-performance semiconductor chips, which makes sense. The world's most advanced chips are overwhelmingly produced by a company called TSMC in Taiwan, which of course is a potential geopolitical flashpoint. Meanwhile, the US has restricted the most advanced chips from being exported to China on national security grounds. Power generation is equally critical. So as the global data center build-out continues, electricity is no longer just an insignificant operating cost. It directly limits how much capacity can be built and how profitable that capacity can be to run. So regarding power generation, the positioning of the US and China is really quite different. So in the US, there are long delays in building out new generation capacity. Grid modernization efforts remain in their early stages, and the marginal price of electricity will continue to be set by the economics of gas-fired capacity for the foreseeable future. And the cost of this capacity, by the way, is increasing rapidly. In China, on the other hand, capacity is abundant, and the marginal cost of electricity is tied to the deflating cost curves of domestic renewable energy sources. So what an irony that there are ample resources for the world's AI build-out. It's just that they're split between two competing hegemons, so they cannot easily be shared. Energy mixes are also evolving all around the world to include more remote and intermittent sources, such as solar and wind. And this is driving substantial demand for commodities that help transmit and store electricity, such as copper and lithium. Medium-term supply growth in these commodities will unlikely keep up with demand growth, in our view, which will likely push these commodity prices higher. And look, the fast-rising physical costs of delivering AI at scale have led many to ask if the age of zero marginal cost software is over, and to be replaced by higher marginal cost AI software. And it's surely true that the marginal costs of software are increasing, no question. But a key question to ask yourself is, to what extent can the marginal revenues of associated software also increase? The promise of AI, of course, is that the software itself will become exponentially more powerful and valuable, replacing the need for relatively higher cost humans. So already today, we have AI technology that is so effective that a $20 per month subscription can replace scores of young graduate employees in certain roles. And, we ask ourselves the question, is this why the unemployment rate of recent college graduates in the US, for instance, is this why that rate has ticked up over the national average in recent years, as you can see in the chart showing? For decades, it was below the national average, and just in the last few years, which has coincided with ChatGPT, that unemployment rate has moved above the national average. And perhaps this is why young people are 3 times more likely to believe that AI will take away more opportunities than it creates. And also likely related, support for capitalism, believe it or not, continues to erode amongst young people. Just 39% of young Americans support capitalism, down from 45% in 2020. So these trends represent significant long-term risks for societies and economies. And just as we are on the cusp of replacing more human labour with AI labour, militaries across the world are racing to replace more human soldiers with autonomous systems. And the race to do so is creating competition for scarce resources. So maps of the world are increasingly viewed through eyes hungry for natural resources and strategic locations. We now know, at least partially, why 15,000 US troops and a dozen naval ships were relocated to the Caribbean, eyeing Venezuela. Greenland appears to be the next focus of the Trump administration, while ambitions for Panama and even Canada have been aired previously. So this intensifying global competition also perhaps explain why China is increasingly eyeing the Arctic and the Antarctic for that matter. Inequality is also growing more extreme in many countries. And at the same time, unaffordability, especially for the young, by the way, whose employment is arguably at greatest risk near term, has become the defining political issue in many countries. So that's where we are today. 2025 was characterized by outsized returns from a relatively small group of stocks. The median stock in the S&P 500, i.e. the 250th stock when ranked by returns, returned only 8.7% in US dollar terms, or approximately flat in Aussie dollar terms, while the aggregate index delivered a total return of around 18% in US dollar terms. Now, if you look at the total returns of all 500 stocks on a single chart, as you can see, it's remarkable that in such a strong year for the market as a whole, more than 1/3 of all stocks in the S&P 500 delivered a negative absolute return. Now, Montaka's key investee companies had similarly significant dispersion in their 2025 returns, and you can see these shown on the screen now. So Unity Software, MongoDB, Alphabet, Tencent, and Spotify all had big one-year gains, but they were offset by declines in businesses like Floor & Decor, ServiceNow, Salesforce, REA, and KKR. Now, to be clear, we believe these declines will prove temporary. So as we've discussed in prior letters and in prior videos, we view Floor & Decor like a coiled spring, an advantaged specialty retailer waiting patiently for a rebound in US residential property sales, which remain near GFC lows. And based on our assessment, the company's undervaluation remains extreme today. Enterprise software leaders like ServiceNow and Salesforce have been sold off as part of a broad brush narrative on software disruption by AI. And we remain cognizant of these risks and we follow them closely. But on balance, we continue to see low probabilities that enterprise customers will be successful at or even try to recreate such large, embedded, mission-critical software systems as ServiceNow and Salesforce. And while critics point to slower than expected adoption of new agentic features as evidence of the decline of these businesses, we suspect these trends highlight just the underappreciated complexity involved in trying to extract corporate value out of AI at scale. And if that hypothesis is right, then this arguably favors those players with scale advantages in R&D, customer distribution, customer data, such as ServiceNow and Salesforce. And following their 2025 stock price declines, we see these businesses as significantly undervalued today. The world's leading alternative asset managers, such as Blackstone and KKR, also declined in 2025, likely driven by a myriad of negative headlines around private credit. In November, KKR CEO Scott Nuttall remarked that, quote, "The noise is bad and the facts are good." Now, we actually agree with this assessment, and we assess that many investors are underappreciating just the cyclical upswing on the horizon for alternative assets. So M&A is starting to come back strongly. Asset realizations will follow, and this will drive further growth in asset recycling and capital raising. Meanwhile, depressed asset classes such as commercial real estate have started to recover, and we remain in the infancy of substantial growth in the private wealth channel for alternative assets distribution. And so we assess that the future looks bright for these businesses. In 2025, even advantaged cloud computing hyperscalers, Microsoft and Amazon, underperformed the broader equity index. Now, this might seem counterintuitive given the extreme advantages of these businesses, including their favorable positioning within the AI revolution and countless meaningful growth options on the horizon. But remember, temporary underperformance relative to the market index is a feature, not a bug, of the stock price trajectories of even the most attractive investments. So, for example, over the last decade, 115 US listed stocks delivered shareholder returns of an extraordinary 10x or more total return. And yet, more than 1/3 of the time, each of these stocks was underperforming the S&P 500 market index over the trailing 12 months by 24% on average. We were a little more active during the quarter because we were presented with opportunities to add to positions with more favorable upside-downside ratios, which were funded by trimming positions with less favorable ratios. So we added to Meta Platforms after its significant pullback in November. We added to S&P Global, Visa and MasterCard, all of which have been growing their earnings power while their stock prices have lagged. We added to ServiceNow, Salesforce and REA, which have significantly underperformed on AI disruption narratives. And these additions were primarily funded by reductions in Alphabet, MongoDB and Tencent following their terrific rallies in 2025. And we also right-sized our positions in KKR and Blackstone, both of which remain in Montaka's top 10, as you can see shown on the screen now. Finally, we added one new investment to Montaka's portfolio during the quarter. This was lithium producer Albemarle, ticker ALB. Internally, we classify Albemarle as an asymmetric value investment rather than a compounder or as an outlier, for example. And we've discussed these different investment types in the past. So our interest in Albemarle stems from our analysis of the global lithium market and the high probability we see for an impending supply shortage. So over the last 2 years, lithium prices have been far too low to incentivize new production capacity onto the market. And this is capacity that would be needed to make the world's batteries over the coming years. And so, frankly, this situation was unsustainable. And now the situation appears to be changing rapidly as lithium prices start to move higher. So in terms of demand, while electric vehicle batteries remain the primary driver of lithium consumption, the market really has been blindsided by the rapid demand for industrial scale battery energy storage systems, or BESS as they're known. So this shift is fueled by the transition to renewable energy sources in grids all around the world, as well as growing demand for reliable power within data centers. So we see a strong likelihood of a price squeeze. And remember, the last lithium price fly up was really quite significant, as you can see in the chart showing. So Albemarle is positively exposed to lithium prices, including prices of spodumene concentrate, which is a primary input for refined lithium carbonate. Among other interests, Albemarle owns 49% of Western Australia's Greenbushes mine, which is one of the world's premier spodumene concentrate mines. So look, as we commence 2026, based on current portfolio positioning, the ratio between Montaka's expected portfolio upside and permanent capital impairment risk has improved to levels we have not seen for quite some time. We therefore see substantial risk-adjusted upside in Montaka's portfolio and are excited about the opportunities that lie ahead. Under MFF Group's ownership, Montaka has continued to expand our team and strengthen our capabilities. Our alignment with investor outcomes remains strong with our personal holdings in Montaka strategies, and this was reinforced in Q4 with MFF Group investing $25 million into the Montaka Global Long-Only Equities Fund. In our quarterly letter, we also shared a sneak peek of Montaka's new white paper that examines the current AI bubble debate. In this report, we critically evaluate 5 core premises, which are shown on the screen now, that underpin prominent arguments that an AI bubble has formed. So, while it is true that one could logically conclude from these premises that we are in the midst of an AI bubble, our analysis suggests that many of the underlying assumptions are either overstated or unsupported by the evidence. So the complete white paper, if you're interested, can be found at montaka.com. We'd love for you to read it and let us know your thoughts. So we'll leave it there. 2025 was quite an extraordinary year of change. And yet in 2026, Montaka will continue to focus on identifying and owning long-term winners wherever possible. Remember, the markets routinely undervalue businesses that can grow their earnings power sustainably over extended time horizons. And these compounders are usually beneficiaries of long-term structural change, and they are also highly advantaged. So it is this rare combination which increases the probability of long duration growth, and this is what the market struggles to value time and time again. On behalf of the entire team, we thank you for your ongoing patience and partnership in our investing journey.